Question 1. Under the Investment Company Act of 1940, which of the following is classified as an open-end management investment company? A. Unit Investment Trust, UIT. B. Closed-end fund. C. Mutual fund. D. Face amount certificate company. Answer: C. Mutual fund. An open-end management investment company, commonly known as a mutual fund, continuously offers new shares to investors and redeems existing shares upon request at the current net asset value, NAV. Unlike closed-end funds which trade on exchanges and have a fixed number of shares, mutual funds issue and redeem shares daily based on investor demand. This structure allows mutual funds to be highly liquid for investors but means their share price is determined by the NAV, not supply and demand in the market. Knowing the classifications under the Investment Company Act of 1940, particularly open-end and closed-end management companies, is fundamental for the Series 6. Question 2. An investor concerned about inflation risk would likely favor which of the following investments? A. Long-term, fixed-rate corporate bonds. B. Preferred stock. C. Treasury inflation-protected securities, TIPS. D. Money market funds. Answer: C. Treasury inflation-protected securities, TIPS. Inflation risk is the possibility that the return on an investment will be less than the rate of inflation, causing the investor's purchasing power to decline. Treasury inflation-protected securities, TIPS, are specifically designed to protect investors against this risk because their principal value adjusts with changes in the Consumer Price Index, CPI. As inflation rises, the principal value of TIPS increases, and the interest payments, which are calculated on the adjusted principal, also increase. Investments like fixed-rate bonds lose purchasing power during inflationary periods, making TIPS a key tool for investors worried about rising prices. Question 3. All of the following are typically considered advantages of investing in mutual funds except: A. Professional management. B. Diversification. C. Liquidity. D. Tax-deferred growth. Answer: D. Tax-deferred growth. Mutual funds provide several benefits, including professional money management, diversification across various securities, and the ability to easily buy or sell shares, liquidity. However, mutual funds themselves do not offer tax-deferred growth unless held within a tax-advantaged account like an IRA or 401k. Generally, distributions from mutual funds, such as dividends, interest, and capital gains, are taxable to the investor in the year received, even if reinvested. This is a key distinction from certain other investments like variable annuities within the accumulation phase, which do offer tax deferral. Question 4. Which type of risk is associated with a specific industry or company? A. Market risk. B. Interest rate risk. C. Systematic risk. D. Non-systematic risk. Answer: D. Non-systematic risk. Non-systematic risk, also known as specific risk or business risk, affects only a particular company or industry rather than the entire market. Examples include a company's management decisions, a labor strike, or a change in consumer preference for a specific product. This type of risk can typically be reduced or eliminated through diversification across different industries and asset classes. Market risk, interest rate risk, and systematic risk, in contrast, affect a broad range of investments and cannot be diversified away. Question 5. When must a prospectus be provided to an investor purchasing a variable annuity? A. Only if requested by the investor. B. At or before the time of sale. C. Within 5 business days of the purchase. D. When the annuity payout phase begins. Answer: B. At or before the time of sale. The Securities Act of 1933 requires that a prospectus for a security must be delivered to a prospective investor at or before the time a sales presentation is made or the order is confirmed, whichever is earlier. Variable annuities are considered securities because their value is tied to the performance of an underlying investment portfolio, the separate account. Therefore, regulators mandate that investors receive comprehensive information about the product's features, risks, and fees via the prospectus before making an investment decision. Ensuring delivery of the prospectus is a fundamental requirement when selling securities like variable annuities or mutual funds. Question 6. Which of the following describes the net asset value, NAV, of a mutual fund share? A. The price at which the fund trades on an exchange. B. The bid price minus the ask price. C. The value of the fund's assets minus its liabilities, divided by the number of outstanding shares. D. The offering price plus the sales charge. Answer: C. The value of the fund's assets minus its liabilities, divided by the number of outstanding shares. The net asset value, NAV, represents the per-share market value of a mutual fund. It is calculated daily by taking the total market value of all securities and other assets held by the fund, subtracting any liabilities, and then dividing that amount by the total number of outstanding shares held by investors. Mutual fund shares are bought and sold based on this NAV calculation, usually performed at the close of each business day. Understanding how NAV is calculated is essential because it's the price investors pay when buying, adjusted for any sales load, and receive when selling shares. Question 7. Which document must be delivered to a customer considering the purchase of a municipal bond? A. Statutory prospectus. B. Official statement. C. Summary prospectus. D. Red herring. Answer: B. Official statement. For municipal securities, the primary disclosure document provided to potential investors is the official statement. This document is prepared by the issuer, like a state or city, and provides detailed information about the bond issue, including the purpose of the bond, the source of revenue for repayment, the issuer's financial condition, and relevant legal and tax considerations. While similar in purpose to a corporate prospectus, the term official statement is specific to municipal bonds and is crucial for investors making informed decisions. Question 8. A breakpoint in a mutual fund refers to: A. A point where the sales load increases. B. A threshold where a lower sales charge is applied to larger investments. C. The point at which the fund stops accepting new investments. D. The minimum investment required to open an account. Answer: B. A threshold where a lower sales charge is applied to larger investments. Breakpoints are dollar levels at which an investor becomes eligible for a reduced sales charge when purchasing Class A shares of a mutual fund. As the amount invested increases and crosses certain thresholds set by the fund, the percentage of the sales load decreases. Financial professionals have a responsibility to inform investors about available breakpoints and to avoid sales practices known as breakpoint violations, where an investor misses out on a lower sales charge they were entitled to. Understanding breakpoints helps investors minimize costs on larger investments. Question 9. An investor opens a variable annuity and allocates premiums to the separate account. Which of the following statements is true regarding the taxation of earnings in the separate account? A. Earnings are taxed annually as ordinary income. B. Earnings are taxed annually as capital gains. C. Earnings grow tax-deferred until withdrawal. D. Earnings are always tax-exempt. Answer: C. Earnings grow tax-deferred until withdrawal. One of the key benefits of a variable annuity during the accumulation phase is that any investment earnings, dividends, interest, capital gains, generated within the separate account are not taxed until the investor makes a withdrawal or begins receiving payments. This tax deferral allows the investment to potentially grow faster because earnings are reinvested without being reduced by current taxes. Taxes become due only when money is taken out, typically taxed as ordinary income. Question 10. A registered representative is recommending investments to a customer. Which document is primarily used to gather information about the customer's financial situation, investment objectives, and risk tolerance? A. Order ticket. B. Account statement. C. New account form. D. Prospectus. Answer: C. New account form. The new account form is a fundamental document used by broker-dealers to collect essential information about a prospective customer before opening an account and making investment recommendations. This form includes details about the customer's financial status, income, net worth, investment experience, investment objectives, e.g., growth, income, safety, and risk tolerance. The information gathered is critical for the registered representative to fulfill their suitability obligations under FINRA rules, ensuring that recommendations made are appropriate for that specific customer. Question 11. Which regulatory body is primarily responsible for enforcing federal securities laws and regulating the securities industry in the United States? A. Financial Industry Regulatory Authority, FINRA. B. Municipal Securities Rulemaking Board, MSRB. C. Securities and Exchange Commission, SEC. D. Federal Reserve Board, FRB. Answer: C. Securities and Exchange Commission, SEC. The Securities and Exchange Commission, SEC, is the federal government agency established by the Securities Exchange Act of 1934 with the primary mission to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. It oversees securities exchanges, broker-dealers, investment advisors, mutual funds, and public companies. While FINRA is the primary self-regulatory organization, SRO, for broker-dealers and the MSRB regulates municipal securities dealers, they operate under the oversight of the SEC. Question 12. The calculation of a mutual fund's net asset value, NAV, is performed: A. Continuously throughout the trading day. B. Once a week. C. At the close of each business day. D. Only when shares are redeemed. Answer: C. At the close of each business day. Mutual funds are valued based on their net asset value, NAV, which reflects the market value of the fund's holdings. To ensure fair pricing for all investors buying or selling shares, the NAV is typically calculated once per day, at the close of the major stock exchanges, usually 4 p.m. Eastern Time. All purchase and redemption orders received throughout the day are then processed at this single, forward-priced NAV. This differs from stocks, which are continuously priced throughout the trading day. Question 13. Which investment company issues a fixed number of shares that trade on a secondary market? A. Open-end fund, mutual fund. B. Unit investment trust, UIT. C. Variable annuity separate account. D. Closed-end fund. Answer: D. Closed-end fund. Closed-end investment companies issue a fixed number of shares through an initial public offering, IPO, much like traditional corporate stock. After the IPO, these shares do not change in number and are traded on stock exchanges or in the over-the-counter market between investors. Their market price is determined by supply and demand and can trade at a premium or discount to their net asset value, NAV. This structure contrasts sharply with open-end funds, mutual funds, which continuously issue and redeem shares. Question 14. Under FINRA rules, all of the following communications with the public must be filed with FINRA except: A. Retail communication. B. Institutional communication. C. Correspondence. D. Public appearance scripts. Answer: B. Institutional communication. FINRA categorizes communications with the public into three main types: retail communication, sent to more than 25 retail investors in a 30-day period; institutional communication, sent only to institutional investors; and correspondence, sent to 25 or fewer retail investors in a 30-day period. Retail communication often requires pre-approval by a principal and may need to be filed with FINRA. Correspondence is typically subject to post-use review. Institutional communication, however, is generally not required to be filed with FINRA, though it must be supervised and reviewed internally. Question 15. An individual wants to open a retirement account that allows for tax-deductible contributions and tax-deferred growth. This describes characteristics of A. Roth IRA. B. Non-qualified variable annuity. C. Traditional IRA. D. 529 plan. Answer: C. Traditional IRA. A traditional IRA, individual retirement arrangement, allows eligible individuals to make contributions that may be tax-deductible in the year they are made, reducing current taxable income. The earnings within the traditional IRA then grow tax-deferred until retirement, when withdrawals are typically taxed as ordinary income. This combination of potential upfront tax deduction and tax-deferred growth is a hallmark of the traditional IRA, distinct from a Roth IRA where contributions are after tax but qualified withdrawals are tax-free, or a non-qualified annuity. Question 16. Which of the following statements is true regarding a unit investment trust, UIT? A. It has a fixed portfolio of securities. B. It is actively managed. C. Its shares are traded on an exchange. D. It continuously issues and redeems shares. Answer: A. It has a fixed portfolio of securities. A key characteristic of a unit investment trust, UIT, is that it purchases a fixed portfolio of securities, such as bonds or stocks, and holds them until a predetermined termination date. Unlike mutual funds, UITs are not actively managed. The portfolio composition does not change once established. They sell redeemable units to investors, and while they can be redeemed with the trustee, they are not traded on exchanges like closed-end funds. This fixed portfolio approach provides transparency and eliminates management risk related to security selection. Question 17. The purchase of an investment product that includes a death benefit and an annuity payout option, with investment risk borne by the investor, most likely describes A. Whole life insurance policy. B. Fixed annuity. C. Variable annuity. D. Term life insurance policy. Answer: C. Variable annuity. A variable annuity is an insurance contract that provides tax-deferred growth based on the performance of underlying investment options, subaccounts, and offers an annuity payout option for future income. It also typically includes a death benefit guarantee, ensuring beneficiaries receive at least the amount invested, minus withdrawals, upon the annuitant's death, regardless of market performance. The investor bears the investment risk because the value of the separate account fluctuates with market conditions. This combination of investment, death benefit, and annuity features point squarely to a variable annuity. Question 18. A registered representative is discussing a mutual fund investment with a client. If the client indicates their primary objective is preservation of capital, which type of mutual fund would generally be least suitable? A. Growth fund. B. Money market fund. C. Government bond fund. D. Balanced fund. Answer: A. Growth fund. A growth fund primarily invests in stocks of companies that are expected to grow at a faster than average rate, prioritizing capital appreciation over income. While offering potential for higher returns, growth funds typically carry higher risk, including market volatility, and are not focused on protecting principal. For an investor whose primary objective is preservation of capital, safer options like money market funds or certain types of bond funds would be more suitable, as they focus on stability and protecting the initial investment amount. Question 19. A customer is considering investing in a mutual fund that charges a 12b(1) fee. This fee is used to cover A. Management expenses of the fund. B. Trading costs within the fund portfolio. C. Marketing, distribution, and sales expenses. D. Custodian and transfer agent fees. Answer: C. Marketing, distribution, and sales expenses. A 12b-1 fee is an annual fee charged by some mutual funds, authorized under SEC Rule 12b-1. This fee is used to pay for activities that are intended to result in the sale of fund shares, such as advertising, promotional literature, and commissions paid to brokers who sell the fund. These fees are deducted from the fund's assets and passed on to investors. Understanding the purpose of the 12b-1 fee is important because it impacts the overall expense ratio and performance return to the investor. Question 20. Under MSRB rules, which event requires notification to the Electronic Municipal Market Access (EMA) system? A. A change in a municipal bonds rating. B. A quarterly earnings report from a corporate issuer. C. A change in the Federal Reserve's interest rate policy. D. The resignation of a corporate bond trustee. Answer: A. A change in a municipal bonds rating. The Electronic Municipal Market Access (EMA) system is the official repository for information on the municipal securities market, established by the MSRB. Issuers are required to submit various disclosures to EMMA, including initial offering documents, official statements, and ongoing disclosures related to the bond issue. Material events, such as a change in a municipal bond's credit rating, bond calls, or issuer defaults, must be reported to EMA to provide transparency to investors and the market. Question 21. What is the primary difference between an A-share mutual fund and a B-share mutual fund? A. A-shares have a front-end load, B-shares have a contingent deferred sales charge, CDSC. B. A-shares are sold only to institutions, B-shares are sold to individuals. C. A-shares have lower annual expenses, B-shares have higher breakpoints. D. A-shares pay dividends monthly, B-shares pay dividends quarterly. Answer: A. A-shares have a front-end load, B-shares have a contingent deferred sales charge, CDSC. Class A shares of a mutual fund typically charge a front-end sales load, which is a commission paid at the time of purchase. Class B shares, on the other hand, usually do not charge a front-end load but instead impose a contingent deferred sales charge, CDSC, if shares are redeemed before a certain period. B shares also typically have higher annual 12b-1 fees than A shares. This difference in fee structure is a key factor for investors to consider based on their investment amount and expected holding period. Question 22. Suitability rules require a registered representative to have a reasonable basis to believe a recommendation is suitable for A. All investors. B. The general public. C. The specific customer based on their profile. D. Only sophisticated investors. Answer: C. The specific customer based on their profile. FINRA suitability rules require that a registered representative have a reasonable basis to believe that a recommendation is suitable for a particular customer based on that customer's investment profile. The customer's profile includes information gathered through reasonable diligence, such as age, financial situation, investment objectives, risk tolerance, tax status, and investment experience. A recommendation that might be suitable for one customer could be entirely unsuitable for another with a different profile. This focus on the individual customer is central to ethical sales practices. Question 23. Which of the following entities enforces MSRB rules on broker-dealers? A. The MSRB itself. B. The SEC and FINRA. C. The Federal Reserve Board. D. State securities regulators only. Answer: B. The SEC and FINRA. The Municipal Securities Rulemaking Board, MSRB, is a self-regulatory organization, SRO, that creates rules for municipal securities brokers and dealers, but it does not have enforcement power. Enforcement of MSRB rules over broker-dealers falls to the Securities and Exchange Commission, SEC, and the Financial Industry Regulatory Authority, FINRA. State securities regulators also have enforcement authority over firms and individuals within their state. Remember that the MSRB makes the rules, but the SEC and FINRA enforce them against broker-dealers. Question 24. If an investor is subject to the alternative minimum tax, AMT, which type of municipal bond interest may be taxable? A. Interest from public purpose bonds. B. Interest from private activity bonds. C. Interest from general obligation bonds. D. Interest from revenue bonds. Answer: B. Interest from private activity bonds. While interest income from most municipal bonds is exempt from federal income tax, interest from certain private activity bonds may be subject to the alternative minimum tax, AMT. Private activity bonds are issued to finance projects that benefit a private entity more than the general public, such as sports stadiums or industrial development projects. For investors subject to AMT, the tax-exempt benefit of these specific municipal bonds is reduced, making it important to understand their tax status before investing. Interest from public purpose bonds, like those funding schools or roads, is generally fully tax-exempt. Question 25. What is the main investment objective of a money market mutual fund? A. Aggressive growth. B. High current income. C. Capital preservation and liquidity. D. Long-term total return. Answer: C. Capital preservation and liquidity. Money market mutual funds invest in highly liquid, short-term debt instruments like treasury bills, commercial paper, and certificates of deposit. Their primary goals are to preserve investors' capital and provide easy access to their funds, liquidity. While they aim for stability, they offer modest yields compared to other investment types and are not designed for aggressive growth or high current income relative to riskier options. Money market funds are often used by investors for short-term cash management.